Everyone, and welcome to a geopolitics, mask off, all kinds of things special. We do a little bit of everything for this one because we're here with one of your favorite guests, Nate Dallon, who is, joins us on Mask Off along with doing such wonderful episodes with me on geopolitics. Now, usually we talk about immigration, but one of Nate's personal hobbies is money. Um, can't imagine why, but anyway, without further ado, before we get into it, I'll have Nate introduce himself and we'll get started.
All right, everybody. My name's Nate Dallon. I'm an attorney in Omaha, Nebraska. I do immigration law, a little bit of criminal. We're going to talk about money and inflation today. I have no credentials, none. But neither did Trump, and he became president of the United States. So I figure I'll just be in good company of the underqualified and overachiever status. And I'll also note I'm not a content creator, although you can find me on Twitter if you really care to, where I principally talk about this exact topic, money and inflation. So there you go.
And he's great, and he's very easy to talk to. As long as you don't piss off his wife, he's absolutely great at getting involved with. That's actually more of a joke. But if it seems like I'm losing my voice, the weather here has been absolutely hell, and I have a lot of drainage, and it keeps getting in my throat, and it's just locking everything up. And I've actually been basically living off ibuprofen the last 2 days because my throat fucking hurts. So, anyway, without further ado, I'm going to turn it over to Nate and his presentation here. I might step away for like 10 seconds just to get some ibuprofen. But yeah,
All I need is a platform. You know me. I'll just talk into the void for a little bit, and then you can come join us whenever you'd like, Ty.
fair enough. All right, so I've got your stream, or I got the stream up. You have a presentation that you want to start it off with as far as the details, and people can see you off in the wonderful distance there. So without further ado, it's all yours, buddy.
All right, thanks, Ty. So I want to tell a little story as to why I became so interested in money and inflation. In the good year of our Lord, 2019, actually, I guess in 2018, I started following Peter Zion on Twitter. And this was back before he had like 1,000 followers. So he interacted with everybody and would chat with folks. He doesn't really do that so much anymore. But one of the people he interacted with, who I thought was hilarious and very insightful, was a guy out of Boston, just a small time guy, not a content creator. He's written a few blog posts, which are fire. I've tried to encourage him to write more. He won't do it. But he's a super smart guy. So I followed him and I started asking him questions. So we got to the end of 2019 and I had tweeted something about incoming inflation problems due to the Trump tax cuts. Trump tax cuts were without having any offsets to the budget. The budget deficit exploded as people thought it would. And so into 2019, it looked like the budget deficit was going to reach this like strange all-time high without a crisis. And I was like, oh, this is going to be inflationary. And he goes, no, it's not. I'm like, what do you mean, no, it's not? He goes, no, that's dumb. The government doesn't print money. And I was like, no. I took econ classes. I'm a poli sci major at BYU, Spanish minor. I went to law school. I paid attention to these things. I did policy debate in high school. I know about inflation. Government deficit spending leads to inflation. And he's like, no, you're a moron. So that's not. And the government doesn't even print the money. The local bank prints the money. I'm like, come on. No, that's what? Doesn't make any sense. It's like, no, banks have like deposits and they can lend out like up to 90% of those deposits, but they have to keep 10% as a ratio. And so they can, lend the money out, but they still have to move the money out of the account. It's like if I put $100 in, they can take $90 out of my account and go send it off to like a loan or whatever, but they still have to have the money. And he's like, no, they don't. And then he linked a bunch of stuff to me. I was like, you're an idiot. You need to go learn. So I'm like, all right. So I started learning and I've never stopped. And so I ran into a couple of really smart people, hedge fund managers on Twitter. They're very fun, the ones who are vocal, because they'll talk to you about what's really going on. I found some really insightful professors from Europe to talk about this stuff. And then I went all over the place. Lately, I've been reading old econ papers from the 1960s and 70s where they talked about this as well. Like, what is money and what is inflation and what is really going on? And the answer is all of the conventional wisdom is wrong. I mean, it is. It's just totally wrong. So we'll start off with the conceptual, the theoretical first, then we'll get more specific as we get into it. So money. There are lots of opinions about what money is and how to measure it. I personally like F.A. Hayek's thoughts regarding money. So F.A. Hayek is a economist and political philosopher. I fell in love with him in high school. I read his book, The Road to Serfdom, kind of solidified my already intuitive conservative bona fide, so to speak. And he says this: money is usually defined as the generally acceptable medium of exchange. So this is the most basic definition of money possible. It's a medium of exchange that's generally accepted. So this could be a lot of different things. It could be cash. It could be coins. It could be gold. It could be silver. It could be a commodity. It could be precious metals. It could be art. It could be laundromat tokens, right? Anything that allows you to exchange for something that you want, whether it be a good or a service, that has a characteristic of money, but then it has to be generally accepted inside of your community. So, like those laundromat tokens I mentioned, they might be a medium of exchange. I might be able to use the tokens at the laundromat and get the machines to do what I need them to do so that they'll wash my clothes, but they're not generally acceptable. I can't then take those tokens and go to the Walmart next door and buy cheese. I might be able to go flip them. So I'll go find a guy and say, hey, I need $10. I've got $11 worth of tokens. Do you want to do a trade? And then he can go use the $11 worth of tokens, and we could do something like that. But the fact is that it's not generally accepted as a medium of exchange everywhere, so that doesn't work. So then F.A. Hayek goes on to say, it also means that, although we usually assume there's a sharp line of distinction between what is money and what is not, and the law generally tries to make such a distinction so far as the causal effects of monetary events are concerned, there is no such clear difference. What we find is rather a continuum in which objects of various degrees of liquidity, or with values which can fluctuate independently of each other, shade into each other in the degree to which they function as money. I've always found it useful to explain to students that it has been rather a misfortune that we describe money by a noun, and that it would be more helpful for the explanation of monetary phenomena if money were an adjective describing a property which different things could possess to varying degrees. Currency is for this reason more appropriate, since objects can have currency to varying degrees and through different regions or sectors of the population. So again, money is any medium of exchange that's generally acceptable. That turns out to be just a really good way to start off thinking about money. Now, of course, that's not the only definition of money. Other perspectives on money include the modern monetary theory approach to money, which I find to be totally fascinating. Some of the people you can Google if you want to learn more about MMT at like a technical, hardcore nerd level, not just like talking points on Fox News level, are Warren Mosler, Rowan Gray, and Robert Hockett. I'll just plug all three of these people. Warren Mosler is an engineer by trade. He went to school to be an engineer, ends up getting an econ degree on top of that, and then he starts trading bonds at a fixed income fund back in the 80s and 90s. And he sort of created the basic concepts of what MMT is. Rowan Gray, he's actually a law professor. He has some very specific comments about what MMT is, what it should do. And then Robert Hockett is also a law professor. He was really deeply involved in the Occupy movement. So these are all left-leaning people. They all believe in government jobs guarantee, a bunch of other interesting things. But they understand the real technical and really interesting parts of MMT. And at a technical level, it's very interesting. But their definition of money goes like this. Money is a government monopoly on IOUs, meaning money is a creation of law. Okay, so that's their premise, is that there's a public monopoly on the currency, on money, and it's run by the government. And we could get into greater details to what that means, but suffice it to say that's the initial important insight, is that money is a government monopoly. They have the ability to print as many IOUs as they want at any time that they want to, and they can create it as a function of the law. So government creates IOUs that are backed by the full faith and credit of the United States, which is another way to say our troops and our police power, as well as maybe you could argue, our reserve status and currency in the world and a few other things. It also means that we can levy taxes which imbue an IOU with value. So imagine for a moment if I said, I'm the government, you owe me taxes every year. A good example of this would be like property tax. So every year, even if I don't do anything with the property, I still have to pay the taxes just for existing. And the government says you have to pay us in our own IOUs. So we, the government, will issue these IOUs, these bills, you will then have to pay us back in these bills to pay off your tax debt. And we're going to put that tax debt on you no matter what. If you're alive, you have to pay taxes. And so you've got to go out and get our IOUs. So the IOUs get value from the coercion of the state. Is another way to think of that. Excessive government IOUs become the generally acceptable mediums of exchange in the broader economy. So what the government then does is they spend more IOUs and create more IOUs than what they actually need to cover their own costs. And then the surplus gets circulated inside of the general economy, and that becomes the generally acceptable medium of exchange. And that's a really cool and interesting idea. We could talk about that in greater depth as well. The state sets price levels, determines inflation, and can control large portions of the economy through central banking. That last one is also deeply complicated. Warren Mosler's writing a really complicated white paper on that topic, just starting, I think, in October. So he's working on that right now, trying to get the technicals beat out on that. But the basic idea is that since the government controls the IOUs, they have the coercive power of the state, then really all economic activity is downstream from the government itself. That's not the only perspective. There's also the Austrian school of money. The three biggies to watch on this is Mises. This is, I think it's Ludwig von Mises. He's from there's now a group called the Mises Institute. He's probably the most libertarian, anti-government economist that I have ever read. He really, really thinks that government is the worst. F.A. Hayek, who I'd already mentioned before, he's an Austrian economist. And then, of course, Milton Friedman, although Friedman might have said he was a monetarist, not an Austrian, but those distinctions are actually pretty minor. For our purposes, I'd put them all in the same camp.
Sorry, can I chime in for just a second? Yeah,
of course.
Friedman is considered part of the Chicago School of Economics, not only because he taught there, but also because he kind of pioneers a different branch of thought. And it's not that he openly hates the Austrians, but he does have serious disagreements with them, in the regard that Austrian School of Economic Theory is largely kind of seen as economic philosophy by most people. It's not a lot about hard numbers. Friedman went his own way in that regard, and he very much put emphasis on put it into calculation, put it into math, and prove by basically by reasonable intuition through formula that these economic principles will work. And this is actually how he gets the negative income tax that I think Mises and Hayek would absolutely disagree with. I think.
That's accurate. Like I said, Friedman's approach says once we make some obvious recognitions that the state is involved inside the economy, and we just take that as a given, then there's no real reason to try to pretend that we should operate in the theoretical world where there is no state, right? Which is what Hayek and Mises are doing a whole bunch of, which is like, hey, let's imagine there was no government. And Friedman is like, why even do that thought experiment? There's always going to be a government. So let's do a monetarist approach, which says we'll have the government do the least amount of harm to the economy possible, right? So I do agree. But for our purposes here, the way that they look at money intrinsically is very much the same. So when it comes to policy prescriptions, they're going to be different. But Friedman comes up with this really important phrase that permeates all of the popular media, which is inflation is everywhere, always a monetary phenomena. And monetary phenomena come from the central bank. So it's his opinion that you really can't have inflation without central banks getting involved. And that's a strong claim. I think that is not entirely true. But he makes a very, very strong case that's difficult to dispute, especially over the last 100 or so years. So that's important. Money is a common medium of exchange. It arises out of barter. And so the Austrian school starts with this basic observation that all trade starts off with a barter system, but the barter system is not very smooth in its exchange. It's not very efficient. So a guy who makes shoes and he wants to get eggs, he can't really trade his shoes for eggs. Now, he could, but he would need a ton of eggs to make up for his shoes. And the egg producer, the person who keeps his hens, is not going to want as many shoes as the other guy wants eggs. So that's a mismatch and an inefficiency inside of barter. So they immediately go from barter to commodities, and they start using a commodity as sort of a form of currency to make the barter inefficiencies go down. Eventually, those commodities become currencies. Currencies are IOUs. They say, I owe you a commodity. So it's a piece of paper which is backed by a commodity. This is how most people think of money. They think that that's the sound or the most sound way to use money and currency in the economy is to have an IOU that's actually there's something to be owed other than I'm just not going to go to jail, right? Like the MMTers believe. And then the Austrian school says that fiat currency is more or less a Ponzi scheme. And so Mises in particular, he really harped on this a lot, where he thought that fiat currency became an immediate Ponzi finance situation, where you play musical chairs until the currency fails to maintain demand and loses its general use as a common medium of exchange. And that's sort of their take. Um, Other perspectives on money, and by the way, this is the camp I would fall into, is the credit creation school of money. This is championed by these three people. James Tobin, he was one of these economists from the 60s and 70s I mentioned before. Carl Brunner, he's the 60s, 70s, 80s, and 90s. And Richard Werner, he's alive right now, and he does really incredible work on this. Their position is that currency, when there was barter, barter only lasted for about 2 seconds, and as soon as you start to get a market up and running, institutions create immediate IOUs that are not backed by anything except the good name and reputation of the person who's issuing the IOU. So banks can create IOU currency out of nothing. And the historical evidence of this is kind of interesting. If you go back to like 1695, there were banks in the United Kingdom that started with no assets. They had nothing in the vault, but they had people who were really good at keeping the books, and they issued their own private currency, and those currencies were successful as long as the bankers maintained a good reputation in the community, and then they would slowly acquire assets to increase their level of trustworthiness in the marketplace so that their IOUs continued to be used as a medium of exchange inside the market. So currency then is loaned into existence by the local banks. Okay, so the local banks loan money into existence. The banks literally say, I don't have money. I'm going to write you a check for $1 million and it's based on a loan. Okay, and then that goes into the broader banking system and creates money out of nothing. So in 2019, the estimate was that 97% of the dollar bills sitting in bank accounts and deposits were created through this loan creation process. And we'll get into the technicals on that, Ty. I know you really like to pay attention to base money like M0, M1, M2. So we'll talk about all those. But it's the studies seem to indicate that banks are in fact creating the overwhelming majority of the dollars that are in the system out of nothing. That seems to be a little bit scary at some level. However, the banks still have their reputation on the line. So there are loan constraints, and those loan constraints are the constraints in money creation. So anyone who's ever gone to get a loan, whether it's just for a credit card, all the way to a business loan or to buy a house or to buy a car, they have a process. This is why your credit score matters so much. This is why your credit history matters so much, is because those become the constraints on which how much money can be produced in the economy before things go bad. All right. So that's sort of the idea. And like I said there at the bottom, 3 or 4% of currency is actually printed by the mint. All the rest of the money comes into existence through loan operations and the banking system. So let's talk about M0. So this is sometimes called the monetary base. And I grabbed these definitions off of the Federal Reserve website, where they say the monetary base, or M0, is the total amount of currency that is either in general circulation in the hands of the public or in the form of commercial bank deposits held in the central bank's reserves. So US M0, as far as I could tell, the math on this was actually a little bit goofy, but M0 seems to be at $6.3 trillion. So for US dollars, there are 6.3 trillion pieces of currency, paper, or coins that have actually been minted by the US Treasury. And that's it. All the rest of the money in the whole world that is denominated in dollars has been created by credit creation. Okay? So M0, 6.3 trillion. That really jumped up quite a bit over the last few years. And really since the great financial crisis, those numbers used to be really, really low. And so the ratio between, base money to overall credit money used to be even skinnier than it is now, which is interesting. So M1, beginning in May of 2020, M1 consists of currency outside the US Treasury. So this is banks. Federal Reserve banks, so that'd be the normal reserve banking system, and the vaults of depository institutions, demand deposits at commercial banks less cash items in the process of collection and Federal Reserve float, and three, other liquid deposits, saving deposits, including money market deposit accounts. Seasonally adjusted M1 is constructed by summing currency demand deposits and OCDs before May 2020, or other liquid deposits beginning May 2020, each seasonally adjusted separately. So US M1 is estimated to be at $20.174 trillion. So this is, the M1 money. A lot of folks don't like M1 so much because it only really looks at the banks and a few other special accounts. It leaves out all your Robinhoods, all of your TD Ameritrade, all your 401k cash holdings. And the number of boomers who have these enormous accounts that are not sitting at a bank but are actually sitting at a stockbroker are pretty sizable, which is why we get M2. Beginning in May 2020, M2 consists of M1 plus small denomination time deposits, less IRA balances at depository institutions, and balances in retail money market funds. Seasonally adjusted M2 is constructed by summing saving deposits, small denomination time deposits, and retail money market funds. That's what MMFs means. Each seasonally adjusted separately, and adding this result to seasonally adjusted M1. Using M2, or US M2, is estimated to be at $21.269 trillion right now. That's a really big number for M2, and we'll see some charts on that later. So that's kind of what money is. I think it's important to understand that money does not require there to be a physical piece of currency, that the gold standard was never really a thing. It was sort of a thing during the post-World War II era until 1971 when Nixon got us off of it. Sort of sua sponte. I'm not exactly sure how he had the legal authority to do that, but apparently he did. But we were on and off the gold standard 100 different times between 1776 and the post-World War II era when we got into Bretton Woods. And so it's kind of complicated, but really money is just an IOU. It's created through this credit creation process, and that's what money is. So when you pick up a dollar bill and you read all the fine markings on it, it says this is legal tender. You can pay your taxes with it. You can always go get your bill exchanged at the Federal Reserve for another dollar bill. And that's really all you can get out of it. But the full faith and credit of the United States is what really has value inside of the dollars. So a lot of people don't like that because they think that's a poor store of value, which is another one of the possible qualities of money. So that's kind of what money is. Any thoughts? You want to jump in on that, Ty? Oh, he's gone. That's cool. Don't even worry about it.
I'm not gone. I apologize. I'm trying to unmute myself and trying to speak. And it's a little hard. So I'll cam up a little bit. Some of this is a little bit more where you're actually more of an expert here than I am. And the reason why is that money's fucking complicated, to say the least, right? And one of the big things that I've talked about recently is that I'm not trying to doomsay people lately when I say this, but I'm like, all right, guys, it's one thing to have the fiat currency system and fractional reserve. You can do that until you have the days of digital currency. And then since that's become the case, fractional reserve banking is pretty much just gone at this point. Because, if you will, I am here in Indiana. Nate is off in Omaha, Nebraska. If I send Nate, like $20, right? It's going to be online. It's not going to be physical, right? Does that mean that the physical money is just shipped off, to Omaha next week? No. Does it mean that some bank just, minused out a few zeros on their thing and another bank put up a few zeros on theirs? Yes. So what you get into is that the way that a lot of people think about currency is very, very outdated in some regards, because going to what he said in the final school of thought there, which I'm not going to say I'm 100% sold behind, but it does seem to have a lot of the ideas that I have, is that a lot of this system is now based upon basically printable credit that a bank has to maintain.
Yep.
And to kind of give you guys this idea, right, is that under the Federal Reserve System, or the fractional reserve system, anyone who goes into 5% toxic loans, right? 5%, the FDIC will come in and wipe you out. When's the last time anyone's actually had to fire off an FDIC claim? 2008. We've literally not seen it. And of course, 2008 was the big bangs. As far as I'm aware, overall, I mean, banking at this point is just literally the whitewashing of money. And I'm not. No, I'm serious, and I'm not. I'm not trying to say this in the regard to just because I'm sure someone's going to be like, "Oh, Tyberius, you don't know what you're talking about." Banks basically now have limited credit generation capabilities, and that is both good and bad because it's good in the regard that it allows people to develop credit and capital in ways that we really haven't been able to before. It's bad because if anyone actually has to check zeros to see if there's actual value tied up into that currency, probably fucked. That being said, there's one key thing I want to get into before I turn it back to Nate, and that is this is an idea from the MMT crowd, but I think it's actually legitimate. Is that money looks to have a carrying capacity, where in the regard that you can have $1 trillion or you can have $5 trillion, right? Why is it that certain countries can print a shitload of money and nothing fucking happens, or very little happens in case of the United States in 2020, when you got like Zimbabwe or Weimar Germany where they print even a little bit money and it all goes to hell? And it looks to be the case that this is more of a hypothesis, semi-hypothesis, semi-theory. What I can tell you by default or by definitive is that it looks to me that there is a certain point where you go from printing money and it barely makes a budge, but once you hit that point, you basically kicked over the bucket and it just pours all out and you just drain all credit and currency, or I'm sorry, all credit and value out of your system very quickly. And that's what we see the hyperinflations like the Venezuelas and, and actually it looks like we're seeing this in Turkey right now.
Oh yeah, for sure, for sure.
So anyway, what I'm going to say here is that I think money has a carrying capacity. I don't know what it is, but it looks to me is that my hypothesis is that it looks like as long as your M0 is at least 2/3 or less of your GDP, you're fine. But if you get up over that, you're basically asking for trouble.
Yeah, sure.
And so I'm going to turn it over back to Nate and let Nate just go at it there. But since he asked my opinion, I'm just going to give it.
No, that's really good. And I think that there's sort of a gut reaction about this whole the currency's not backed by anything. That must mean it's bad. And I want to say that there is no question that if it is backed by something, that the confidence inside of that as a generally accepted medium of exchange goes way up. Because ultimately, it's just a confidence thing, right? Anytime you have an IOU, the entire worth of that IOU has to do with confidence. The person issuing the IOU and the person receiving the IOU. They both have to have trust. And that trust, having a commodity or something of value connected to that IOU absolutely helps with trust. However, and this is the however part, you have to think of the money supply as being an incredibly dynamic pool. Right? It's a pool that is literally pulsing every day. Gets bigger, smaller, bigger, smaller, bigger, smaller, bigger, smaller. And what are the things that are driving that bigness and smallness? What's driving the creation of new dollars and the destruction of old dollars is supposed to be market forces, right? Supply and demand. As someone who makes a bad loan defaults on that loan, that causes a little shudder and the amount of money shrinks, currency shrinks, right? Whereas if you do a good loan and it comes back and pays well, it bumps, okay? So that becomes this game where you say, where does the trust come from a fiat currency? And the answer, in my humble estimation, shouldn't be, well, the government, the full faith and credit of the United States. No. It comes from the knowledge that the fiat currency is being controlled by this creation process inside of the market itself. So if the banks are the ones making the decision, good loan, bad loan, good loan, bad loan, and they've got those standards correct, things will go well. And we'll have confidence that the market is determining what the size of the money pool is, not some other actor. The problem is, and Ty was sort of alluding to this, is that as soon as it gets too big or too small, it becomes a problem. Too small, that's a deflationary bust. That's the Great Depression. The Great Depression was not an inflationary problem. 1929 in the United States was a bust, right? And by the way, that bust occurred because we had gone fully back onto the gold standard, and the gold reserves didn't move fast enough to grow to meet the needs of the population at the time. And so eventually, they hit a limit, and they started to have deflationary pressure, and that deflationary pressure persisted all the way into the 1940s. So the Great Depression has to do with too much money being destroyed too quickly. Inflationary pressure is like Weimar Germany, where policymakers were determining the size of the pool, and it was growing too rapidly, and the underlying economic forces weren't there to regulate it. So the regulating factor inside of money and IOUs generally needs to be market forces, because that's where the greatest level of trust will come. Now, take something like Bitcoin, just because I think it's fun. So Bitcoin is also not backed by anything, right? It's not fiat currency because there's an algorithm that limits the ability for growth inside of the Bitcoin universe, right? Inside of the pool of Bitcoins, it is limited by the algorithm itself. So what does that do? Well, that increases the trust inside of Bitcoin itself, because we know it can't be printed into oblivion. It has that limitation. There's also other real high upside for cryptocurrencies when it comes to trust, and that has to do with the blockchain. Right? The blockchain creates an incredibly high level of trust when it comes to the barter transactions, when we would use Bitcoin A to exchange for a good or a service coming back. The problem I've seen so far with the cryptos is no one's using it as a medium of exchange. It's only being used as a store of value. People find that it is much better, much more profitable, much more rational to just allow Bitcoin to appreciate, to allow Ethereum to appreciate, sell it for dollars, and then use the dollars as their medium of exchange. So almost in a sense, Ethereum and Bitcoin are becoming the commodity that people feel more comfortable backing a fiat currency, which is interesting. And there's a whole line of thoughts. There are some people online who think that's the end game, is we're not actually going to use Bitcoin as the mechanism by which we exchange things, but Bitcoin will become the trust factor inside of a sovereign central bank, and Bitcoin will limit on money creation by stupid central bankers, right? At least that's one of the lines of thought there, which is, I think, fascinating. So again, just getting back to this, the fiat currency itself has trust built into it, and that's through market forces when it's done correctly. But market forces, when there is too much money, the market says, time to correct, we call that a market correction, and we want to shrink the amount of money, and sometimes that creates a deflationary bust, and it takes some years to reinflate through normal market processes the quantity of money needed to run a functioning and dynamic economy, especially a modern one. So people, they get nervous about that, understandably so. Yeah, just think of it as like almost a living entity. It's like a little blob of cells that are growing, expanding, and shrinking dependent upon the underlying information rising up from the market itself, what it's supposed to be. Then we get to the inflation question, right? You say, well, okay, hold on. The market then would punish as soon as inflation started to happen. So you could have inflation where the banks just make a series of really bad loans, and they're doing it all across the economy, and that causes an unnecessary inflation. The market will come in and pop that bubble and shrink it all back down. Well, what if we throw the government in? And so this is where we get some of the inflation definitions. An increase in the quantity of money. That's Ludwig von Mises. He just says, hey, as soon as the pool of money gets too big, that's inflation. Too big to what? We'll talk about too big to what. Like, how do you measure if it's too big or too small or whatever? We'll talk about it. 2, inflation is the decline of purchasing power of a given currency over time. So you might say this is just its general devaluation. So maybe you're not seeing 4% inflation every year, but over a 10-year period, the purchasing power just goes down a tiny little bit every single year. That's also a form of inflation. The third definition that I found online is inflation is the rate of increase in prices over a given period of time. So if you see that prices are just continually going up, that's actually a version of inflation itself. And then the last one is a continuous increase in the price level of what? Of everything, goods, services, you name it, determined by the state. So this is the MMTers. The MMTers think that the government gets to determine what the price levels are. And that is deeply troubling, because that's them saying, oh, the only time inflation can occur or hyperinflation can occur is if the state chooses to become hyperinflationist, not because they accidentally became hyperinflationist. Whereas most of everybody thinks that, no, governments are not able to figure this out, and they will inevitably cause hyperinflations. So it's interesting. All right.
Can I, if you don't mind?
Yeah, go ahead.
Yeah, 2 things. Number 1, I made a claim about 2/3 or M0 being 2/3 of GDP. Sorry, I completely mental typoed that. I don't know what it is. I was actually just going over the Turkish data, and literally it's just watching Turkey just literally pull a Weimar Republic and just shove more and more money. It definitely seems to be at some point you lose the faith and credit of people, and then your money just bleeds value. And I don't know exactly where that point is, or where people, where that point hits, where it's going to do, but it eventually does happen. Oh, okay. 3 things now. Number 2 is hello last username. I haven't seen you for a while. I actually messaged you on Discord. You have been missed very much. Hope you're doing well. And the third thing is that this is actually the big disagreement I have with MMTers, is that I think they're not horribly off. I don't think that they're wrong on some stuff, but I do not think that governments actually have a lot to say in regards to setting price levels unless you're in some highly command economy stuff. What largely it is more, for me, it's option 3, is that it looks like more often than not that prices have a ratchet effect, and the reason why it does is that anything that isn't a base commodity, right? So oil, like technically it would be bauxite, right? Coal, stuff that's like straight up on the bottom end of the extraction services chain is the only things that are really easy to go backwards with. Everything after that point, particularly the farther you get through the value added chain, means that it has to have everything before it go backwards before you can reset the price level on that item, right? So if you're talking about alcohol as an example, right? You guys like your bourbon. You're looking at the price of the barrel, you're looking at the price of labor, you're looking at the price of the grain, you're looking at, all these things. And if you just have one reset, why would you reset your price just because you may have a momentary lapse in the price of, say, grain, right?
Mm-hmm.
What I think actually happens here is that the more complicated your good is, the more highly active, or the more involved it is in the value added chain, the less likely it is to have a market correction, because it needs market corrections for everything below it to have a lower price level. This is what we call a ratchet effect in economics, where once you hit a certain level, it's really hard to knock back down. You can go up all live long day, but going down, that's not really a thing. And I think that's actually the number one cause of what we call I think it's cyclical inflation, where you just see like that 1 or 2% go off of your, 1% or 2% of a year go off of your value. That's just part of doing business, where everyone's, raises their prices to adjust for, paying their workers more or what have you. I'll get to the other one where we get to demand or supply push and demand pull inflation, which is probably what we're seeing now, but we haven't hit that point in his presentation. So without further ado, Nate, thank you for letting me have it.
No, that was great. So the Ty started mentioning the specific market forces that are supposed to help regulate what exactly the money supply is. The way to think about this conceptually, so I've put up the magic chart. This is your basic Econ 110 chart. I find that it's very, very helpful to think through these concepts sort of piece by piece and slowly. And so we've got an X and a Y axis. The X axis is Q for quantity. The the Y axis is P for price. And then you have a supply curve and a demand curve. And so just so that we're all clear about this, you'll notice that the red demand curve starts up at the corner of the price chart, okay? And then and slopes downwards towards the bottom right-hand corner of the quantity axis. And then supply does the exact opposite. So the reason this is an aggregate supply and demand chart, meaning we're not looking at a particular supply chain or item or service or good and determining what the demand and supply is. Ty was kind enough to send me a whole bunch of charts that kind of go through all the different ways in which the supply curve can have a slope that causes weird price action to occur. The demand slopes do the same thing. So certain goods are like inelastic, so that means that the demand curve is very steep. Some are very elastic, which means they're very flat, so they're easily substituted. There's just a bunch of different things. But it's where they intersect, that little PQ dotted line, the purple dot right in the middle, that's what we call the imaginary price. And why do I say it's imaginary? Well, this would be an equilibrium. Aggregate demand and supply equilibrium gets us this particular price. Aggregate supply and demand means all of the demand in the whole country, all of the supply in the whole country. P, price, that has to do with the quantity of money available, right? So P is going to be determined by how much money people have, all right? Now, how they got it and other things is a little more complicated, like we talked about before. That has to do with loans and like all these other factors. But their willingness to pay for a certain quantity of supply and demand depends on where those things touch. So if my demand personally is higher than the aggregate demand, my willingness to pay a price might be higher than the economy generally. So the economy generally might not want very much. Like, I don't know, Ty, what's your favorite retro video game from the mid 2000s? Like Perfect Dark? Do people still play that game? I don't know.
You know what? Well, let's just say Command and Conquer's Generals. Let's go for it.
Okay, perfect. So let's say you wanted to get your hands on an original in-box CD 500 megabit Command and Conquer game, right? The supply of such is extremely small, but the demand is probably not very big either, right? And so you then, Ty, are in a position where you're willing to pay a whole bunch more than the majority of the population for this particular item. It's a very rare item, but nobody else is really bidding for it either. Well, now let's imagine that there's 30 dudes, they're all looking for the same one, and they all have a very high propensity to pay. You guys might start bidding the price up, right? And it would just rise and rise and rise and rise. Could you call that inflation? No, I mean, you could, right? Because prices moved. Price is going up, and it's not because of any other factors having to do with supply or the demand. It's just we're trying to find price. It's price discovery. We're trying to find the price where it prices out everybody else, and the one guy who wants it the most, he has the most personal demand for that thing, he's finally going to acquire it through price discovery. Well, you could say, from an aggregate demand standpoint, now instead of just taking the 30 guys and one copy of Command and Conquer, we generalize that out to the entire economy. Demand might shift in such a way where aggregate price moves and goes up without money being created or destroyed. Okay? And Ty sort of mentioned this in passing where he said, you might have demand side inflation or supply side inflation. And just think of it that way as instead of the P axis getting moved around, instead of the Y axis getting moved around, the demand curve shifts upwards. That means demand went up, price goes up because demand shifted upwards. Or on the flip side, supply might slide down and then drive prices up along the demand curve as well, right? So you could have supply destruction, which drives up price, or you could have demand destruction, which drives down price, or you might have demand growth with supply stagnation. So supply shrinks a little bit, demand grows a whole bunch, and you would still see price action, and the actual underlying money supply wouldn't have moved at all. And so that's just important to understand is that there's kind of three things going on. Did demand shift up or down? Did supply shift up or down? Or did the quantity of money in the economy grow or decrease? And all of those things are happening together to create the magical purple dot of price equilibrium. And understanding where that is day to day is basically impossible, right? Like what I'm describing is a deeply complex variable that really only exists in the abstract. It can never actually be calculated because as soon as you calculated it, it moved, right? Like it's already over. We've moved on to the next thing. So it's just a conceptual way to think about it. I personally believe, as I think Ty might as well, that the inflation we're seeing right now has less to do with money growth and a lot more to do with demand sliding in weird ways and supply sliding in weird ways. And there's a lot of different things that go into those. But I think it's an important thing to conceptually kind of have in your head. Ty, did you have anything you wanted to comment at this point?
Yes, I do. Two things, actually. One of them's a big one of them's not. The one that's not, we'll start with that, is that we're largely in agreement that this is what we call... I actually was just talking with some of my fellow econ guys. Apparently, this is actually supplied push inflation. I always think of this more as demand pull inflation. I'll get into that a little bit if you want me to, or I'll let you tag at it. Here's the hammer that I have. I don't know whose economic doctrine this one is, and I think I actually take a little bit of pieces from everybody's and get this particular take. It seems to be like a Tyberius unique take. There is supply and demand curves for almost every item and every commodity. I think everyone knows this. But I'm pretty sure, at least to a significant degree, that money actually has its own supply and demand curve as well. And that you can actually have too much of a supply of money, you can actually have too much of a demand for money, and you can absolutely drive the cost of money by how much is within the circulation. The thing is that most governments, far often more than not, try to maintain some level of stability. And what we've seen throughout most of I would say better part of the last 30, 40 years, is that when we drop money into the system in any kind of record amount, more often than not, particularly in the Western world, it's always during a time of crisis. And particularly, it's actually when we're at risk of a deflationary bubble. So what
Yep.
tends to happen is that we seem to get away with doing the wrong thing at the right time because we're doing it at the right time. And that is, we're dropping money into a system that should be shrinking, that should be going into a full market correction. We'll just throw 2008 at you, right? No. Let's do 2020. 2020
Okay,
is
sure.
2020 is everything shutting down because everyone isn't allowed to work or isn't allowed to go out and buy stuff, right? So 30% of the workforce just up and leaves because they have to. It's basically Great Depression to Electric Boogaloo. Here's the big thing that is different between 1929, or if you will, more 1930, and what is going on in 2020. 2020 is we drop over $1 trillion into assets that shore up a lot of the things that should go into correction. And so, if you will, is that we literally just took out a big snowblower and blew all the snow into the hole that was created, and we just piled over it. Now, here's the real question. The question is, and we're going to get into a completely different thing here, so I'll just leave this on the table, is does that hole actually become ice? To where, no, seriously, does it become ice? Does it shore itself up and can we keep going along with it? Or does it eventually form a chasm where if we go around the cycle again, we literally just have the hole that's 5 times bigger now because it's a sinkhole? And so, like, we'll have to touch that, but we've got a lot of things to still cover during this presentation, not only between what Nate still has left to cover, but I have to cover as well. So I'm going to turn it back over to him. But
I want to say, Ty, because it's that I think is the question over the next decade, right? The way that you phrased it was a little cavalier. We'd have to unpack the metaphor just a little bit, but that is exactly the question, which is, can deficit spending maintain an economy that wants to shrink? And can it do it for a long period of time until the shrinkage stops and then growth picks up where it left off? I believe that is the central economic question for the next 10 years in the United States, and could possibly be, just depending on how things go, the central question for the next 20 years. And so that's a topic that we'll have to come back to and talk about in depth about, what kind of deficit spending is good, what is bad, et cetera, because those questions, I think, are the meat and potatoes of what our political questions should be about over the next 10 to 20 years. So I think it's incredibly important. But you're right, that's not exactly the focus today. Let's talk about government action.
1 second.
Sorry, go ahead.
I need to I'm making a note for anyone who's watching the recording or the stream. If I just drop out all of a sudden, I hear a lot of thunder outside, and so everything is recording and whatnot. But if we just suddenly lose me, you just forewarn. Tornado watch, storms, all that. Without further ado, sorry, Nate, go at it.
All right, yeah, guys. If Ty gets picked up in a tornado and survives, we're gonna have to make a movie about him. So we'll have to fundraise money. We're going to have to get cameras and a crew and go out there and interview him and his family and about how awesome the experience it is. I love tornadoes. I know they kill people. They're very, very dangerous, but they're also just like incredible and amazing, and I love them so much. The end. All right. Government action. How does government action affect price, supply, or demand? So let's talk about it. Does it shift the y-axis? So that's that price. We're talking about the quantity of money. Does it shift demand? Does it shift supply? 2020 is a beautiful example of this because lockdowns shift demand down, right? So the demand for normal everyday things starts to drop because you're staying at home. Not all things, obviously. You still need to eat. You still need toilet paper, right? There's a whole bunch of hilarious things that happen. But demand collapses due to government action and mandated lockdowns, right? The lockdowns were very devastating to demand. Lockdowns weren't only devastating to demand, it was also devastating to supply. So supply starts to collapse, right? It also shifts downward. And when those types of things happen, you start to see all sorts of price action inside of the economy. So I don't know if everybody remembers. I know right now we're very focused on oil prices, but it was like May of 2020, oil future contracts went negative and gas got down to $1.05 a gallon in Omaha. Well, what caused that? Supply more or less stayed the same. Demand collapsed because people were locked down in Omaha. So our price collapsed. That was a demand destruction, right? That caused prices to start to go down really, really quickly. As demand then started to pick back up, the price started to rise to where it was. But then we had these supply issues. The suppliers had a 6-month period where no one wanted their oil. They couldn't get a good price on it, so they shrunk production. right? And so we start to get these mismatches. As the system tries to find equilibrium, it becomes difficult for equilibrium to occur and price stability to set in when the government keeps flipping on and off the switch of vaccine mandates, no vaccine mandates, of mask mandates, no mask mandates, of lockdowns, no lockdowns. All of that government action is shifting demand around. Now, of course, there's other things that are shifting demand and supply. Seasonality, like there's certain months of the year where a lot of things happen, right? People travel a lot, or they build a lot of homes, or they run their AC at a particularly high level. So that might cause demand to shift upwards because of season, because of our distance to the sun. And then it might shift back down. And then maybe supply shifts depending upon what commodity you're looking at or whatever good or service you're looking at, because it gets too cold. We can't cut down, excuse me, lumber in Alaska because everything's snowed over, right? So supply and demand are affected by non-government action as well, but the government action gets in there and it sort of stops the equilibrium and price discovery process from occurring naturally, and the government messes with it on purpose. And I just want to mention that because the government can mess with the price of a commodity a million different ways. It's not just through the printing of money. It could be regulation that messes with supply. It could be with taxation that messes with demand. It could be lockdowns. It could be vaccine mandates. It could be sin taxes, right? What happens to the demand curve for cigarettes if you have a 50% tax on those? Like, you could see how all of the government action is pushing demand and supply curves all over the place, messing with price. And when price is unpredictable and moving a lot, it's very difficult for private companies to serve their customers in a way that is good for everybody, and equilibrium can't occur. Okay? So I think it's just important to think about those are the things that are pushing demand and supply and price all over the place are those factors, and the government is increasingly a big factor inside of the basket of factors that push those things around. Government treasury auctions. I am now going to make the most hardcore claim of my presentation. The US federal government does not print money. And I think that deserves a lot of hate. So chat, come through and call me an idiot, because this is a very bold, very intense claim, but I'm going to make it, and I'm going to make it strongly. The US government does not print money. Okay? Now, why do I say that? They mint money. There's absolutely no question that they mint money. So there is actual production of money. By the way, the Mint's website is themoneyfactory.gov. I kid you not. Themoneyfactory.gov is the actual US Mint's website. So they can print it, but they are constrained. They can't actually just print whatever currency and denominations they want, however they want. They are constrained by the banks who put in the requests for the currency to be issued. So they can't just issue currency on their own. The banks can ask for the currency to be issued. And then what's the bank's limitation? The bank's limitation is the banking code, right? The Federal Reserve Act of the United States for large banks. And for smaller banks, they're limited by market forces. If they ask for too much minted money to come out of Treasury, they have to have the books to back that up. And if they lie on their books, they'll lose their license and they'll cease to be a bank, because the whole system's based on trust. So there is some printing that happens, but it comes as a reaction to the private banking system, and the private banking system creates the money in the first place through credit creation, and then the coinage takes place as a secondary effect. Now, there was some chatter of a $1 trillion coin, because some people think that legally the mint might be able to issue a $1 trillion coin. That, of course, would have been massively inflationary, because there would have been no credit creation from the banks underlying that, and we would have dropped $1 trillion into the overall banking system. That would have been, I think, very devastating. Not everybody believes that, but I certainly do. So this is from the government, or this is from the Treasury's website on auctions. To finance the public debt, the U.S. Treasury sells bills, notes, bonds, floating rate notes, and TIPS, Treasury Inflation Protected Securities, to institutional and individual investors through public auctions. Treasury auctions occur regularly and have a set schedule. There are 3 steps to an auction: announcement of the auction, bidding, and issuance of the purchased securities. All of the debt goes through the auction house at the Treasury. I'm going to say that again. All of the debt goes through the auction house at the Treasury. That is so important. If the government just wanted to print money without having raised taxes, we wouldn't call that debt. Right? Just as a point of logic, you wouldn't call that debt because you wouldn't have to pay anybody. You just printed it and threw it out to the people. And so the debt calculators that you see and like the $100 billion that gets added on every 40 minutes or whatever it is nowadays, there is actual debt that must be paid by the federal government in the future. And that debt was created at the Treasury auction house. So how does this work? The Congress says, I need $1 trillion. The Treasury says, we only raised $200 billion in taxes. We now have $800 billion that we need to raise through the Treasury auction house. So they then say, we're going to issue some 90-day notes. We're going to take $100 million at 0% interest for 90 days, and then we'll pay you back. And they do that from the 90-day all the way up to the 30-year Treasury, okay? And they have all sorts of different interest rates along those different securities that they sell to people. And then people take money that already exists in the economy, and they give it to the federal government, and in return, they get a security, meaning a bond, a T-bill, a tip, right? Any of those things that are listed in that paragraph. I've put on here the market yield on U.S. Treasury securities at 10-year constant maturity. So this is from the Fed website. The St. Louis Fed puts up all of the Fed's data, and so you can get that every day. And this goes all the way back to 1963, I think. What the interest rate is how much money the Treasury has to promise to give back once the bond reaches maturity, meaning it has reached its age. And so they give back 100% plus a certain interest rate. So the highest it has gotten in the recent past was up above, look at that, 15%. So this is a 10-year Treasury note. So I could go to the Treasury and say, hey, Treasury, I'm going to give you $100. You're going to give me back a piece of paper that says, I promise to pay you, Nate Dallon, $100 plus 15% interest, so $115 in 10 years. Okay? Now, why is it that the rates were high in the 1980s? No one wanted to go to the auction. Okay, so if no one wants to show up to the auction, you raise the price for the U.S. government by making it more attractive by raising the interest rate to attract people, or they say, man, 15% is not bad. That's guaranteed money. The U.S. government hasn't missed a payment since the Civil War. If I can get guaranteed 15%, maybe I should go buy bonds. And so then they go to the bond auction. They put in their $100, they get back a note that says 10 years from now you get 115 back. Since 1982, look what's happened to the interest rates. They have collapsed. The debt has gotten easier for the US government to issue. More people are showing up to the auction over time. More and more people are showing up to the auction every single time. More and more people show up, keeps driving the price down. Totally fascinating. But I just want to mention this again. The government does not print the money. They raise the money from the Treasury. They don't print. Why don't they print? Because that power was not given to the Federal Reserve or to the Treasury. They could, right? And that's what the MMTers want. So if you ask the question, I don't understand MMT, MMT says this process of doing all this bond stuff is stupid. Just print the bills. There's no reason why you need to go out, get yourself into debt, just print the dang stuff, right? They are advocating for actual printing of the currency. And whereas I'm contending that what's really happening is that the government is using the bond market as a way to suck money out of the private sector into the hands of government, where they then push it out the door in terms of payments and paying the military and building bridges and paying Social Security checks. But that money comes from a combination of taxes and the bond auctions themselves. And it's this weird thing where the more we have spent through the government, the more the price has gone down. So this red line that I've added to that exact same graph we were looking at before is the federal debt, right? So federal debt, total public debt as a percent of gross domestic product. Here's what's happened. There is a goofy relationship where the less debt the U.S. has, the more the rates rise. And the more debt the U.S. government has, the more the rates fall. It's one of the great accidents of all of public policy. If you want to ask yourself, why is it that the Republicans always talk a big game about balancing budgets, but when push comes to shove, they never do it? It's because of this graph. Because every time a Republican takes office, they go, hold on a minute. I can actually borrow the money cheaper than the guy before me, and then I can go hand it out to people who like me. Why would I not do this? And it's a very powerful motivator. It's a very powerful motivator. So obviously you can see in 2020, there was a straight line that went straight up, and it pushed debt to GDP through the roof. And of course, that has consequences. But at the same time, what happened to the Treasury auctions? We sold more Treasuries at the cheapest rate ever. So, like, it's just madness. So the overall quantity of money from a policy standpoint is supposed to remain the same. Government spends, so it looks like, oh, government spending is getting too high. We're printing money. And then the Treasury comes in and says, bond auction, we're sucking the money right back out. Right? And so there's sort of this dance between the spending and the Treasury auctions. And the Treasury auctions keep taking all of that money that looks like it would be inflationary and grow the pool too fast. It sucks all that out into the Treasury through the Treasury auctions, and they hold on to that money, and that keeps inflation under control. That's why we don't have spiraling inflation every single time the government decides to deficit spend. Now, I say that, and everybody in chat's probably like, Nate, what are you talking about? I was born in 1980. Prices have gone up basically every year. And I concede that. Here's the Consumer Price Index, right? So this starts since, I think it is 1946 is when the CPI data started. And you can see that 1950, it stayed pretty flat. Then it has this little uptick. So that 1970 uptick is when we get off the gold standard, right? Not surprising. Suddenly, it gets the slope of the curve gets up and has remained up. You'll see there's a pretty significant dip where CPI goes negative right during the 2008 financial crisis. And then it goes up, and then it goes really up over the last year. And so we've had consumer prices have gone up a whole bunch, and a lot of people think it's because that we've printed too much money. And I would contend that it's what we talked about earlier. Government policy destroyed demand, and then they used fiscal, meaning money. They sent out stimmy checks, and the stimmy checks pushed the demand curve up to before the lockdowns, and then it pushed it up even higher. So people started consuming more than they've ever consumed before, and that's because they were given so much free cash, right? That's what I think happens. There's another way to look at CPI. This is the Sticky Price Consumer Index, food and energy, right? Less food and energy. So this is the CPI minus food and energy, and look at that. It looks very different. So if you're taking a look at things that don't touch oil and food, well, then your CPI graph looks very, very different. This I find very interesting, and I've put a link here, Ty. I don't know if anybody cares to look at it, but it's measuringworth.com, where they talk about this very hard question of how do you actually figure out what the value of something was in the past? So the guy who runs this blog says, and he's an economist on the East Coast, he says economists are often asked, what is something worth? Since that is not a very precise question, there's no precise answer. The usual answer uses the language of opportunity cost. The worth of something is the cost of the most valuable foregone alternative. The worth of something is relative. It can only be measured in terms of the value of something else. When the comparison involves time, the common practice is to inflate or deflate the number at one point in time to the dollar of another point in time using a spliced priced index such as the Consumer Price Index, CPI. We were just looking at it. Yet in most cases, the question, what is the current dollar price of a number from the past, is not a perfect substitute for the question, what is the relative value of a number from the past? The greater the time difference between past and present, the greater the likelihood that the CPI will not reflect the item in the same manner at both times. So the guy who runs this blog created this little chart. This is price per gallon of gasoline, national aggregate, okay? And he has price per gallon, and then he has real price. The price per gallon on the left is what the actual number was in the year. So that's just the normal number. In October 2008, we were paying $4 a gallon nationwide in the US. He, however, has adjusted it to the real price. And so he takes labor considerations, and so like the average the average income of a middle-class American, and he adds that into the equation where he says, how much is $4.06 relative to a middle-class income in the year 2008, and he gets the real price of $5.11. Here's why it matters. 1933, gas was 18 cents a gallon. he does that same analysis. What does 18 cents what does 18 cents mean in 1933 dollars relative to how much a person who's middle class earning at that time? And then he does the same calculation for today, and he comes up with $3.59. So you could say that the relative real price of gasoline is actually cheaper, at least in Omaha today, than it was in 1933, even though the absolute price rose. Why do I say this, and why do I bring this up? It sounds like I'm just trying to do some voodoo magic to make it look like there's no inflation. It's that my purchasing power is more important than the absolute cost of a particular item. And so if my purchasing power is actually slightly higher now to buy a gallon of gasoline in 2021 at $3.59 than it was in 1933, then I don't think real inflation has happened relative to myself and my own income. I can actually consume more gas in 2021 at that price than I could have in 1933. So that's kind of the idea. That's it, Ty. That's my spiel. Talk to me. Tell me of the ways.
Yeah.
What's chat saying? Does chat think I'm stupid? I haven't even looked at this.
No, there's some people that absolutely are disagreeing with you. There's some people that absolutely think you're great. But that's usually what happens when it comes to chat.
I love you, chat. By the way, everyone who thinks I'm stupid, I totally understand that. And like, I think that what I'm talking about today is so counterintuitive and so against what you would hear in a lot of econ classes and what you're going to hear on like MSNBC and other reputable, like good places to actually go for information. I do recognize that my burden of proof is pretty high to try to show that these things are true. So if there's any one particular place you want to burrow down into, I could show you some of the underlying data for why I think it is the way that it is.
Okay, yeah, there's a lot of things that I want to talk about. The problem is I didn't make notes, and if I hadn't muted myself, like half of the time you guys would just be hearing goo goo goo, and because it's just a bunch of goddamn thunder out there. He's shaking on top of me right now. Like he's just like fuck this, like save me. So
well, it's cool. How about this? I'll propose then that Ty goes home and takes care of his people. I've done my little spiel, and then chat. Just blow Ty up with a million questions. We can bring me on another day, and I'll go through them all.
No.
I think that'd be totally legit.
So far, everything's holding out. It's good. It's just I just forgot to make notes because I just wasn't able to. So I'm sure chat made plenty of notes. So if you guys want any questions from me or Nate or both of us, if you guys want to kind of like bring back some of these questions, go for it. If I think you're being an asshole or bad faith, I will beat the living crap out of you. But if you have a legitimate, honest question that you want to like address, happily put it in chat at Tyberius D, and you can even say, "Hey, question for Nate, question for Ty, get on it."
Yeah, I'm just kind of flipping through here. Fleet148 mentions, what about the transition to central bank digital currency? Awesome question. This could be again one of these super defining questions having to do with monetary policy into the future. The answer is it ruins everything. Right? I mean, like literally is going to ruin everything. So I just mentioned before that right now the banking sector has the job of regulating the quantity of money out in the universe. A central bank digital currency eliminates the need for private banks almost entirely. Not truly entirely, but really close. Because now I, a private citizen, will just have a bank account at the Federal Reserve, and they can put money in and take money out at their leisure, right? Now, I'd assume that they're not going to be total sociopaths about this. What they'll at least not at first, what they'll probably do is say, yeah, you've got this new digital bank account, just do direct deposit from your employer. They'll direct deposit it into this account. This is your account now. Well, that sounds all well and good, except does the Fed have any real motivation to pay attention to market factors, profitability, and their own personal reputation in making decisions about how much money should be created through credit creation? No, it totally wouldn't, right? So a central bank digital currency takes away what is supposed to be the best mechanism by which to figure out how much money the market should have by taking it out of the private sector's hands, where they're soaking up all this important information on the ground, giving it to these policymakers at the central bank, and the central bank doesn't care. Like, the things that they have in terms of what their objectives are things like full employment. I mean, is there a world where we're fully employed and starving? The answer is yes, right? The answer is obviously yes. Their goals are not the type of goals that you need to help constrain how much money is created or destroyed inside of the economy. So handing it over to the Fed would be an unmitigated disaster. It would be immediately inflationary because, of course, if they really want full employment, guess what the easiest way is? Shove money into accounts. Suddenly, every employer is like, well, everybody's got money. I guess we can hire anybody because inflation keeps going up. I can pay people money because there's so much circling around, and you could become Weimar very, very, very quickly. Right now, to give an argument for the other side on that, they might say something to the effect of, "Oh well, we'll watch that. As soon as we see the inflation numbers start to rise, we'll just top it off." My concern would be, you're too late. By the time inflation starts to show up in the data, we're already 45 days down the road of all that inflationary pressure. We're just realizing it today. It's already been happening, right? It's already backward looking. So you're always going to be late to the game, which means they're always going to be wrong. I just don't know how it's possible to say, oh, well, we'll just watch the data and sort of wave it off like, oh, we're smart, trust us. It's like, no, it's not because you're not smart. It's because the data on the ground takes time to percolate up to the central bank. You're not going to have it and be able to make decisions, especially regional decisions, when one bank's running the entire monetary system by themselves. It's a terrible idea. And it would be the absolute destruction, I think, of our economy. And it would make us an immediate command and control economy. If one of the big differences between the Russian system and the Chinese system was that the Chinese kept banks regional instead of all centralized in Beijing, whereas Moscow took all the banks and stuck them right in Moscow. And that immediately made them less competitive and ruined their country, right? And so I think that would be an absolute unmitigated disaster. I'm totally opposed to a central bank digital currency. And then, of course, you could get really spooky and say, what about a social account, right? Like, oh, you were at January 6th, you were at one of the protests at the Capitol, you just get no money. We're just going to take your money away. I mean, what would stop them from doing that, right? Like if your local bank did that, guess what? Millions of people would leave that local bank. They'd go out of business. Does the central bank care? Nah, they don't care. So you could get really spooky on that level. And I think it's a very good question. I think it's going to come up more and more over time. But it would really cause me concern. Again, not because I think there's inherently bad people. I want to make this really clear. I think that it's functionally impossible to run the system wisely because of the constraints of being a human, right? Like there's just no way to do that. You have to decentralize that decision making, even if you had the smartest, nicest, most altruistic person in the world running the central bank. Of course, I don't believe we would. We'd probably have somebody more nefarious. So like, well, I can't see it working. So anyway, that's just my take on it.
Question, or I can't speak to it personally, but there is another question that I can speak to. 41 year BC, interesting name. This is from Twitch. What would you consider an unacceptable amount of U.S. debt? Who wants to go first? Nate's like, oh my god.
I mean, it's okay. So the answer to that question is complicated, and it's only complicated in this way. There are sort of three buckets of debt that matter. There's the central government's debt. That's kind of what I've been talking about, is the federal government itself. They're not the only ones who have debt, though. Like, remember, the bigger drivers of debt are corporate and private debt, and those are other buckets. So, and so this is where it gets slightly complicated. Is it possible to have a federal deficit? Excuse me. Is it possible to have a federal deficit that's like over 100% of debt to GDP and still be in a healthy position? I think the answer is yes, but that would mean that the corporate sector has very little debt and that the private sector has very little debt, right? So if the government's going to have high debt, then the public needs to have low debt, right? So like the private consumers and the corporations need to have low debt. If they're all going to have high debt together, so if you have 100% debt from the federal government and you have 100% debt from the corporates, you have 100% debt to GDP from the private sector, you've now cleared 300% debt to GDP in the aggregate, and you've got a crisis on your hands, right? And so the answer to that question is you kind of have to take a look at whose debt and how much total debt's in the system before I could give like a solid answer to that question. So I would say right now, corporate debt is incredibly high and government debt's incredibly high, and private debt, consumer debt, is actually quite low. So two of the three buckets are overflowing and one bucket has some space. But something to watch. If you start to see that consumer debt creeping up, right? So if we get into March, April, May of next year and consumer debt's taking a big jump up, start to get worried, right? Because once all three buckets are overflowing, that's when a deflationary bust normally happens. So we got to keep a sharp eye on that. And so I guess my answer is right now I don't feel comfortable with the federal government's spending because of the corporate debt hangover that we have. But, all these things are very dynamic and they can change fast. So we'll just have to keep an eye on it.
Okay. So the problem with this on my end is that it's so much harder because you can't apply micro rules, right? For a micro rule is that if you want to be as basic and as simple as possible, is that whatever debt load you want to have, you can have as long as you don't go into negative assets, right? And almost no bank would ever let you do that anyway, or at least you're basically have to get a loan shark to let you get away with that kind of thing, right? But the other side of that, number one, is that like at what point do you want to have enough rigidity, or if you will, enough assets to cover your own ass in case something goes to hell? Because there is times where your assets can lose money, and if you lose too much, you can get in a negative stuck. And this is actually one of the deflationary spirals that we saw in 29. Was not only the fact that you had debts go to hell, but you had people's assets go to hell in a handbasket where, particularly within the U.S. stock market as a whole, was that you had a bunch of people who were borrowing on the margins, and then all of a sudden basically their borrowings were no longer even worth what they had originally bought the stock for because it wasn't worth anymore, and it basically caused a run, and it just trickled all the way down and just kicked everyone's ass. That can happen in real life. We saw a bit of that in 2008 with people's mortgages. Is that not only did people already have, we'll put it this way, there was a lot of people that already started off with getting shit that they weren't supposed to have, and I'll totally hang the bankers for that shit because they knew what they were doing and they fucking did it anyway. But on the other side of that is that, if you were an average American citizen who was middle class, just doing everything right, is that there was a lot of people that was still able to make their payments, but their asset of their home was worth less than the loan it was still left for it because of how much
underwater.
How much of that market had taken a hit. That can happen to this day. Now, usually that means a sign that a lot of things have gone to hell. But anyway, in a nutshell.
I love that. I love that comment, Ty. I just want to piggyback off that because I think some of the folks in chat have started talking about, well, how do assets connect into the overall credit market?
I was going to go there.
And the answer to that is kind of like you were just describing. It's in order to keep confidence high, the bank, want to give loans to people who have assets. So in the case of default, I can go after your asset, sell it, and then make up for the losses on the loan. So that's a mechanism by which we securitize a loan. So that's why we call it a security. So like mortgage-backed securities was that idea. Your mortgage secures, means increases the confidence, your loan. The mortgage became a secure, a confidence-boosting element inside of the credit market. But just as Ty said, as soon as that asset starts to have a free fall, the whole purpose of the asset was to increase confidence. But if the asset price starts to go to free fall, what does it actually do to confidence? Creates a snowball rolling down a mountain, right? Like that becomes the problem. So on the front end, it seems like taking an asset and connecting it to a loan is like a great way to help decrease the risk that the loan will go bad. But at the same time, if suddenly a huge number of assets all go south really, really fast inside of a credit market, all credit stops. And as I've kind of discussed since the beginning, if you have a credit freeze, quote unquote, that means the money system is no longer pulsing. It can only contract. It can't expand because no more credit can be issued. So if a credit market freezes, no new dollars can be created. There's only one way to go, and it's down, right? And so that's why those things start to happen. So assets absolutely unlock the door to cheap and large amounts of credit because it's supposed to give this sense of, oh, that's a smart loan even if that person fails. And is that always true? No, and we saw that in 2008. I don't know if anybody has seen The Big Short, but Steve Carell's character goes to Miami and is chilling at a strip club, and he asks one of the strippers how many mortgages she has, and she said 6. And she's making about $1,200 a week, which is actually quite a bit of money, right? I mean, that's not a zero income, but definitely not enough to support 6 homes, 6 mortgages, right? So you can get into these situations where bubbles form, the credit market gets way out beyond where it's supposed to be, so the market kicks it in the balls to sort of cause a contraction, and the government's like, no, we don't like the contraction, and so they go in and they do a credit binge. So the Federal Reserve Bank will create a bunch of credit to the banks to increase confidence. That confidence then will unfreeze the credit markets. And that's kind of what they did in '08.
Okay, so I want to hit that one, and then Nate, remind me to get back to federal debt and how much is too much. So
Okay.
I want to piggyback off that because it's one of the things I wanted to go at. The way that I analogize what I said earlier, and I'm going to restate what I was talking about, is that whenever the United States government now largely comes into an entire an asset market, particularly housing, or if you will, like we had in 2000 was even bigger, or I'm sorry, 2020 was even bigger because it was airlines, it was all kinds of stuff that was just losing value because it was no longer in use, right? When the government comes in and they basically just give equity, or at least gives people a shovel to start filling their hole in, here's the real question that comes out. And I don't think there's a definitive answer here, is that whenever you fill that hole, is the hole filled with concrete? Did you fill it up correctly and that you can just kind of go back along and you can step on it? Or does it become basically a hollow thing and it becomes a sinkhole and you can fall through? And to rephrase that into a more direct term, is that how do we know that the inefficiency or the correction that was supposed to be made was solved whenever a market collapses and yet the government comes in and fills that back with the equity out? And here's the real issue. Sometimes people absolutely learn from the mistakes of the past and they start fixing stuff. But sometimes they don't. And here, one of the two biggest concerns I have economically going ahead into the 2020s, 2030s in particular, is that are we going to have all of these market inefficiencies come back to bite us because no one learned their damn lesson?
Right.
And I'm gonna be honest. Here's one of the big ones that I'm kind of looking at as we didn't learn our lesson. Housing's still stupid. Like, no, seriously. You know what? Things might be nice here where I live. Things might be not too terribly bad in Omaha. But, a decent house almost anywhere. And we're talking a decent is, 2 to 3 bedrooms, a driveway and maybe like a quarter acre for a fucking yard. $150K minimum. Anywhere you go. Right? And if you're talking about major metropolitan areas, that's $1 million. Right?
Mm-hmm.
Forget inflation. No. It's not worth that damn much. It's space. It's nice things, but it's still a place where you go. It's an asset that you live in. It's not something that's actually generating you money. Something that generates you money is going to have a high net asset value. Something that you just live in, that is your domicile, should never be that much. And so, I'm just going to put it this way. I think that we didn't learn our lesson from 2008 in the regards that we still treat our houses more like an asset than an actual, what it is. It's a domicile. It's where you live. It's going to have some value because it's, made of things and you can resell it. But we've absolutely, completely lost the market on the fact that it's a home first. And if you look at how things have been priced out from what I've seen versus 2000 to 2020, you're going to find that we're probably up 30 to 40%. I'll double check my numbers here just as a whole. But last I checked, our net assets overall are way too expensive for things like houses, and cars are getting that way too.
Yeah, so a lot of good thoughts, Ty, and of course part of this gets back to we should probably have a separate conversation for another day about the specifics of debt. I think that you're exactly right to say that debt that generates an income stream is way different than debt that doesn't generate an income stream, right? And so if you take debt and then you use that debt to buy an asset and that asset becomes productive and gives you money into the future, that's a pretty good debt instrument, right? That's a good loan. If you just get a huge loan so you can go vacationing in the Bahamas, that's not going to get you an income stream back. That's a terrible loan, right? And so I think that's really good. And then we could talk about that, how that affects different industries and how that in the aggregate affects the United States and the federal government and how it does credit creation. I think that's really important. Two things that I saw that were interesting in the chat. It looks like Paul X BSOG, I don't know, BSOG, I don't know how you say that, Paul.
Paul's great. But anyway,
No, yeah, and he brings up this point. MMT is real. Okay, so I actually love MMT. Listening to Warren Mosler opened my eyes on so many things, and I love the take. And there's actually a synthesis between the strict MMTers like Mosler, and then also this credit creation theory of where money comes from. And the bridge is this guy named Hockett, and he's also brilliant. And he's very kind, by the way. Like, he's a deeply kind man. I followed him on Twitter, tweeted a few things at him. He followed me back. He's answered every question I've ever asked. And he sent me one of his papers. He's a law professor at Princeton. And he said, hey, actually, Nate, you're onto something with this whole, like, the whole MMT paradigm doesn't take into consideration how credit creation is working. He goes, however, here's the bridge. Every bank is a franchise of the Federal Reserve. He's like, so imagine for a minute that the Federal Reserve is McDonald's corporate headquarters, right? They have certain powers, they control branding and the menu and a bunch of stuff. But then individual McDonald's franchises, they get to determine hours and wages and, how big their staff is and how quickly they want to move off of staff to technology. It's like, that's the same thing. The Fed has franchised their money creating authority to private banks. And so those private banks, they have discretion as to how they create that money, but it's all regulated, right? Like, there are very specific rules that they have to follow, or else they get their franchise revoked. And so the Fed could come back to a bank that says, hey, you're misusing your printing power. We're going to yank your license, right? So again, there's still this connection back to the central government and how IOUs are created. And so in his opinion, there is that mechanism of franchise and central authority helps understand or helps bridge the gap between MMT creation of money and private credit creation of money. And I think it's brilliant, and I really respect Professor Hockett an enormous amount. And I think that's actually quite good thinking. And so just to get to Paul's point, I don't want to like poo-poo MMT in that sense. The thing I get worried about is if you want to centralize and take away the franchises and say there's only corporate McDonald's, I think you lose decision-making authority, or excuse me, not decision-making authority, you gain authority. You lose good decision-making power by centralizing that much so the data can't be tailored quickly and efficiently like it should at the lower level. Again, a strict MMTer might say, well, we have supercomputers now. Like, we're in a position where that argument, Nate, might have made sense in the 1950s, but we're now in a position where we can crunch all the data, and we could, using machine learning and much of other stuff, do it correctly. Call me skeptical, but I at least think that I should mention that there is such a synthesis out there.
All right, so I got two things. The first one is just an addendum to what I said. All right, remind you that between 1990 and 2020, basically the value of money on the whole was lost by half, right? So figuratively, if you spent $1 in 1990, you need to spend $2 in 2020 to get the same thing, right? The median sell of a house in the United States in 1990 was $123,900. The mean sell was $149,500. What do you think it was in 2020?
No idea. I seriously have no idea.
The median was $329.
Oh, goodness gracious.
And the mean is $383. So yes, guys, we have completely fucked up the value of our homes. So I'm going to double down on that one and say, yes, we really need to look at what we're doing for our asset costs, because I think that one's going to, I don't think we fixed the inefficiency that was supposed to be corrected back in 2008, and that's going to burst again, 100%. And what's probably going to burst it, unironically, is boomers dying.
Yeah, that's right. Yeah, demographics, that's a great point. So, Ty, you and I, we've got to do a bigger economic chat using some of this background information we've just talked about, because this is so many specific. But demographic shifts cause huge gyrations in supply and demand, right? And price levels. Like, people ignore that, and like the demographics are just so critically important, and one of the other big normal market forces that moves those.
One of the biggest things that people talk about in the 1980s is like why we got there, like, hey, how did we get to basically stagflation, all this stuff. I'll say in the late 70s is that one of the big problems is that we got to a point where the capital market got to be a bitch because things started really ranking up. And then on the other side of that is you had a bunch of people coming into the market where demand exploded, and you had a massive offset. And that's how one of the big reasons you got stagflation is that you had the OPEC crisis, all this stuff at one time. So you had an enormous amount of demand, and you couldn't get the supply to match. And getting the capital to even invest in the supply was primarily really hard. Right?
Yeah.
So you roll into the 1980s, And what's going on here? Why is it that you have all this demand? Why you have it that you have a limited supply? Because you just doubled the number of young people that are in the workforce within 5 years, and these are called the baby boomers. Because remind you, if you're born in 1955 or 1960, which is the height of the baby boom generation, you are literally just flooding into the marketplace in a whole nother level. And another thing that we did that was, not necessarily it largely had started in the post-World War II era, but it really hits home in the 80s, is that not only do you have men entering the workforce who are young, but you have women entering the workforce when they're young at record numbers. And this is going to sound bad, and it's not meant to, but women entering the workforce in a certain way actually hurt them and hurt the American family, because it pushed down the price of labor. Because while you need that second income, particularly if you're a new mom, in that day and age, is that actually being there helped push down labor even further. And it's actually one of the reasons that we saw the amount of the amount of money you could get for your labor stagnate since 1980, right? So
no, hey, look. First of all, we got to say no sexist after you make a comment like that. Just like we're dropping no racist after we say slightly racially insensitive thing. We got to say no sexist, but women messed up the labor force. I think we need to drop that in there. No sexist.
Yeah. Well, okay. So no, here's the reality. Like, I'm not going to say no sexist because it's not meant to. It's not meant to be like, hey, women, good job, you fucked us over.
Hey.
It literally is. It's literally a socioeconomic problem that can happen. All right. So I'm not going to.
Yeah. Hey, Ty, I hate to tell you this. I don't care how mathy your rationale is. Twitter has made it very clear to me, your intentions do not matter. You still need to throw out the sexist afterwards.
Yeah, number one, this is why we don't go to Twitter. And number two, this is why my wonderful chat and my viewers are so much better than the rest of Twitch politics. And I thank you so much. Anyway, so here's the other thing. I need to answer the original question that was given to us. How much is too much of federal debt?
Yeah.
I would honestly say that if you just kind of want to give a normative, is that never cross 100. Granted, we're already over 100. We're at like 129 or 137. Like with the last spending package. Can't remember. It keeps changing. We're pushing it to a level I think is uncomfortable. And this definitely probably wants to be, or at least wants to be, one of the bigger notes I want to do. I'm afraid that one of the things that we can walk into is a debt deflationary spiral, which absolutely can happen. And actually, that's the thing that I've talked about for literally the last 10 years. That I've been speaking on is that, you can actually look at my old blog if it's still up on Blogger, if you all can find it. Is that one of the articles I wrote was like the end of the social democracies. Is that we keep putting more and more money onto the system, right? And that's fine, I guess, in its own way. But here's the problem. What if you're putting all this money into the system where you're taking out loan after loan after loan, and it's not building out an economically advantageous assets, right? So you have 200% of government spend or of government debt to GDP, right? And then all of a sudden, instead of paying 1%, 2%, 3%, is that you're looking at 5, 6, 7, or 8. Why would you do that? Because the things that you've invested in are no longer making the amount of return. That means that there's a capital crunch. And we could see a capital crunch just because of the fact that boomers are retiring or boomers are dying, right? So that money isn't in the system. They're taking it out as they retire. So number one, we can see that. And I think actually part of 2020, or that the overheating that they were talking about back in 2019 before it all went to shit with COVID was actually part of that. But we all forgot about that. So anyway.
Well, I think it's an incredibly important line of thinking, right? To sort of slowly think through all those things, and I think that's what we need to talk about on the next chat like this. If I could throw up some graphs, man, I'll show you some we'll get deep in the weeds on this debt stuff, and we could start thinking through all the different consequences. Just so everybody knows, I love the production function, which means you start with three factors of production. It's land, geography, labor, demographics, and capital, which means your monetary system and trust, international trade, kind of all wrapped into one.
Technically tools,
and so,
but yeah. Like,
it's
anything that's a force multiplier, right?
Right. And then some people even say that, technology should probably be like a fourth factor into itself. I don't know.
No, it's capital.
That seems...
It's literally...
Yeah.
It falls within capital. Go on.
Right, it should. It definitely should. So you have these three factors of production, and so you have to ask yourself, like, okay, how are all the different factors of production sort of combining together to help create our GDP? And so I think, Ty, if we started with that as our base model and we said, look, here's what's going on with land and regulation and discovery, right? And then here's what's going on with the demographics, and then here's what's going on with our capital outlays. One of the factors of production inside of capital is debt capital, right? And that's capital flows. I mean, some people like to talk about it in those terms. And so, anyway, it becomes very interesting to sort of think through that. I would argue that we're in a situation where all the new debt that gets added creates a diminishing returns effect that actually drives overall GDP down. But in order to make that case, that's the punchline. But in order to make the case, I think we'd have to go through, like 20 slides to show that. But I think that no matter what you do with the debt that we're going to create over the next decade, it's going to be very difficult to get big economic growth because there's already too much debt. We've overused a factor of production, and overusing it more will not fix the problem. But we'll see. Anyway, I actually have to bounce. So I love you. I appreciate this. Chat, you guys rock. I know it's like super Nerdville right now, but I think we're all here because we want that. So I hope you've had a good time. If you continue to ping Ty with questions, I'll be happy to answer them at a later time. I think it's an important and fun conversation, and it's very counterintuitive. So anyway, that's all. Just wanted to throw that out there. You guys rock.
All right, thank you very much. Are you going to hard exit right now, or do you want to just, do a quick outro real quick?
No, I don't create content. I don't care if you follow me. Just much love and peace.
All right, fair enough. That was... Give me just a second here. Oh, no, it's not working. Give me a second here. Let's try that. Yeah, there we go. It's a little goofed up. Light sensitivity is all jacked the hell up. Let's try this. Let's try that. There we go. A little bit better. So, without further ado, my name is Tyberius D. I was joined by Nate Dallon, and we had a wonderful conversation on economics and debt and all this. Economics, money, more importantly, debt, all this other stuff. We're about an hour and 40 minutes in. And anyway, to make a long story short here, I think Nate even brought some stuff that I wasn't aware of. My specialty is in developmental economics. It's not about, like, hey, how does this particular money system work versus another? That's not really what I study in. My primary thing as an economist, or as a person who works with economic measures, is what's going to give you a return. What makes you more money, right? And for somebody who actually is a person who hates to actually put money into investments because investments scare the crap out of me, is that my whole thing is just looking at, all right, cool. Are you going to get more money out of giving somebody a textbook, or building them a road, or, getting them a meal at the end of the day? And that's largely what my studies focus on, is that what has really good ROIs, what's actually, if you have to choose, if you got 5 priorities that you have to worry about, but you can only do 2 of them, that's the only 2 you can find, which one are the ones that are going to allow you tomorrow to pit 3 of them instead of 1 or just 2? That's what I largely study in, and so if I was a little bit off the beaten path with this particular conversation, that'd be why. Just a different thing. Anyway, without further ado, I've been Tyberius D. I was joined by the wonderful Nate Dallon, and if you have any questions for me or him, feel free to PM me, or find him on Twitter at Nathan Dallon. He's very easy to find. And anyway, without further ado, I hope you all have a wonderful time. We'll catch you next time. Later on.